Wait, so let's paint the picture. It's Tuesday afternoon. The market's just chopping around, doing its thing.
Total snooze fest.
Exactly. And then boom, you look at your screen and there's just this massive green candle erupting out of nowhere. Talk about Zurn Elkay Water Solutions, ticker ZWS.
Yeah.
The stock closed up 10%. 10 to $51.77.
It was a serious wake-up call. And it wasn't just the price action, right? The volume was, it was screaming. 2.5 million shares.
That's heavy.
For a company like this, in this sector, that is high conviction volume. Someone wanted in, and they want it in now.
And that is what we're breaking down today on Talk Tickers. We are diving into the Q4 2025 earnings for Zurn Elkay to figure out why the market suddenly fell in love with what I frankly thought was just a plumbing company.
See, and that's the trap. If you think Zurn Elkay is just brass pipes and water fountains, you are missing the entire story. This isn't just a plumbing play anymore, it's a water management play. We're talking high-tech filtration, sustainability, and, based on this report, one of the most efficient cash flow machines in the industrial sector.
All right, but let's be cynical for a second. A 10% pop on earnings, that usually means something fundamental changed. Or maybe they just guided so low that it was easy to beat.
That's a fair question. But no, this was a genuine, high-quality beat and raise, and the options market tells the story. Priced in maybe a 7% move, up or down.
A normal earnings straddle?
Exactly. And ZWS blew right past that. This is what you'd call a flight to quality. The market is rewarding pure execution. And the key word from management all through the call was record.
CEOs love that word. Record this, record that. So let's strip away the hype and look at the actual math. What did the headline numbers really look like?
It was clean across the board. Revenue came in at $407.2 million.
And the street was looking for?
Consensus was around $400.75 million. So a solid beat. But more importantly, that's up almost 10% year over year.
Okay, a 10% top-line growth is strong. But revenue is vanity, right? What about the actual profit?
Adjusted EPS hit 36 cents. The expectation was 34, so a 2-cent beat.
2 cents doesn't sound like it's worth a 10% rally.
It's not, and that's not the real story. If you want to know why the stock moved, you have to look at the margins.
Ah, okay. This is where it gets interesting.
Their adjusted EBITDA margin hit 25.6%.
Okay, pause. Let's unpack that. For anyone who isn't staring at a terminal all day, why is 25.6% such a big deal?
EBITDA is basically a measure of a company's operating cash flow. And in manufacturing, a 25% margin is, well, it's elite. But the real number here is the change. It expanded by 100 basis points.
A full percentage point.
A full 1%. They became 1% more profitable on every single dollar of sales compared to last year. In this inflationary environment, that's incredibly difficult to do. It means they're running a much, much tighter ship.
So my concern there is always, are they just cutting costs to the bone? Are they starving the business to hit a number for Wall Street?
The data says no, and the proof is in the cash flow. They generated $83 million in free cash flow in Q4 alone.
Just in 3 months.
And for the full year, fiscal 25, a record $317 million.
Wow. $317 million. That's a massive amount of cash for a company this size. And looking at their balance sheet, they're not drowning in debt either.
Quite the opposite. This is one of the cleanest balance sheets I've seen. Their net debt leverage is at 0.4 times.
0.4. So for every dollar of earnings, they have just 40 cents of debt.
Roughly, yes.
Yeah.
It's the lowest in their history as a public company. Most industrials run at 2, maybe 3 times leverage. Zurn Elkay has basically no debt.
Which gives them a ton of options.
Yeah.
So what did they do with all that cash?
They returned a lot of it to shareholders. They bought back $25 million of their own stock in Q4, $160 million for the full year, and they paid out $64 million in dividends. So they're rewarding shareholders, and the bank account is still overflowing.
So financially, they are a fortress. Let's go back to those margins. How are they doing it? If they're not just cutting costs, what's the secret sauce?
It's the ZEBS factor.
ZEBS. Sounds like a character from Star Trek.
It stands for the Zurn Elkay Business System. It's their version of the famous Danaher Business System. It's all about continuous improvement, lean manufacturing.
Kaizen, all that stuff.
Exactly. And management said their supply chain plan worked flawlessly in 2025. But there was a specific detail in there about China that really caught my eye.
Right. This feels like a huge strategic pivot.
It is. They are actively exiting direct material purchases from China.
But everyone is trying to do that right now. It's a huge talking point.
Everyone is trying. Zurn Elkay is doing it, and they're ahead of schedule. They're on track to have only a few percentage points of their cost of goods sold coming from China by the end of 2026.
That is incredibly fast. Moving a supply chain like that is like turning an aircraft carrier.
It proves the ZBS system is real. And it helps them navigate tariffs, too. They realized about 5 points of price in Q4 related to tariffs.
Wait, explain that. Realize 5 points of price. What does that mean?
It means they raised prices by about 5% to cover tariffs, and their customers paid it. They passed the cost right along. That is the definition of pricing power.
So operations are tight, the balance sheet is a fortress. But you can't just cut costs forever. Where's the growth coming from?
That brings us to the story. They aren't just selling metal anymore. They are leaning hard into water quality. We're talking PFAS, those forever chemicals, microplastics, lead.
All the stuff you hear about in the news. And you have the EPA with the new lead and copper rules, which has to be a tailwind.
It's a huge tailwind. But management sees it as a steady drumbeat, not a one-time spike. It just sustains long-term demand. And they didn't wait for the government. They launched a new product line called Pro Filtration last summer.
I saw that. At first glance, it just looks like another water filter. What's the big deal?
But it's a business model shift. This system has a proprietary head.
Meaning?
Meaning you can't just buy a generic filter off Amazon to replace it. Once you install their system, you have to buy Zurn Elkay filters.
The classic razor and razor blade model.
You got it. They are locking in high-margin, recurring revenue. And they made it easy, a 30-second filter change. If you're managing a school with hundreds of these, that time savings is huge.
That's smart. And they're wrapping it all in a sustainability message too, right? I saw a stat. 2.4 billion gallons.
Yeah, their products filtered 2.4 billion gallons of water last year. They say that's the equivalent of saving 20 billion single-use plastic bottles.
20 billion. That's a staggering number.
It is. And it matters. Every big company has ESG goals now. This helps their customers tell their own green story. And they even partnered with TerraCycle to recycle the used filters.
Closing the loop. I like it. Oh, and before we move on, the hand dryer. The sanitize and dry thing with cold plasma.
It sounds like science fiction, but it's real. It creates plasma that neutralizes 99.99% of viruses, like COVID and the flu, without any chemicals. It just shows they're innovating beyond their core.
It's impressive. Okay, so operations are dialed in, new products are flowing. What's the outlook for 2026?
The guidance is strong. Core sales projected to grow mid-single digits, but again, look at the margins. They're targeting around 35% incremental adjusted EBITDA margins.
Okay, incremental margins, break that down.
It means for every new dollar of sales they get next year, 35 cents of it will drop straight to the bottom line as profit. It's highly efficient scaling.
And that fuels the cash flow, which they're projecting at. What was it?
Around $335 million for 2026.
So with all that cash and no debt, management used a very specific phrase about M&A, a cultivation funnel.
The cultivation funnel, I love that. It means they're actively farming for deals. That 0.4 times leverage. Their balance sheet is just underutilized. It's too safe.
So they're going shopping.
They are. They're looking at adjacencies in North America. Water tech, professional grade plumbing. They want to buy their way into new markets.
I also saw a mention of data centers in the Q&A, which kind of surprised me.
Yeah, you don't really think plumbing when you think about AI.
Right. Water and servers don't usually mix.
But those data centers need massive cooling systems, heavy-duty plumbing, and fire protection. Zurn Elkay has significant content in them, and they said orders are accelerating. It's a great high-growth area to offset the tougher residential market.
Okay, so let's put it all together. Why the 10% rally?
It's a flight to quality. It was a quality print, clean beat, record cash flow, and a credible path to higher margins. That 35% incremental target, that justifies the premium. The market is paying for execution and certainty.
And they got it. All right, we've covered the facts. We've covered the strategy. Now it is time for our favorite segment.
Oh, here we go.
This is not financial advice. This is where we pitch an outrageous but maybe plausible trade idea just for fun. So, what's the play here?
I've been staring at this balance sheet. That 0.4 leverage is lazy capital. It's just sitting there.
Lazy capital. I love that. So what do they do with it?
I'm calling this one the levered water monopoly. They shouldn't just do small bolt-on deals. They need to swing for the fences.
Go big.
They should execute a massive transformational acquisition by a residential filtration giant or a smart water metering company. They've got the cash flow to service way more debt. They could lever up to 3-4 times and get billions in firepower.
And the logic there.
They could effectively corner the market on regulation-compliant water, just as all these federal mandates on PFAS are tightening. They become the standard oil of clean water.
The standard oil of clean water. I like that. I have a different take, though. The other side of the coin.
Yeah, let's hear it.
I'm pitching a private equity take-private arbitrage.
Taking them off the public markets entirely.
Look at the profile. PE firms love steady cash flow, low debt, and sticky recurring revenue. That proprietary head on the filters, that is recurring revenue gold.
It's a PE dream.
A private equity firm could come in, pay a 30% premium, and take the company private. They load it up with debt because the balance sheet is clean. Use the cash flow to service the debt, strip out public company costs, and just milk that cash cow.
That is actually incredibly plausible. The cash flow is so stable, it could easily support the debt from a leveraged buyout. It's a bond disguised as a stock.
Exactly. It's a cash machine waiting to be taken private. But again, not financial advice, just a fun thought experiment.
Dreams of leverage.
Always. Okay, so let's wrap this up. Zurn Elkay delivers a record year. Margins are up, cash is flowing, supply chain de-risked from China.
The 10% move shows the market believes the compounder story. The key thing to watch now is Q1. They need to hold that 25-26% margin level to prove this is the new normal.
If they do, this rally has legs. Thanks for listening to Talk Tickers. We'll see you on the next print.